apologize for that. So let's start over, and welcome to the Dividend Power Hour for this Saturday edition. I see a lot of you guys on here, a lot of you telling me there was no sound, but we are back now, and hopefully we have sound. If no one can hear me right now, then definitely let me know, but it looks like we are good to go. So I see a bunch of people that have entered now, so hopefully the majority of you missed the no sound debacle, but we are back here for the Saturday edition of the Dividend Power Hour. So welcome, happy July. Let me know where you guys are viewing from. I thought it was a great idea to be able to, I get a lot of questions about international folks that say, hey man, I wish I could join the Dividend Power Hour. I wish I could just ask questions live, but instead they have to message me and don't get that live interaction. So, doing a Saturday once in a while is a great opportunity for those folks, as well as bringing in some of the regular viewers as well. So happy July 1st. It's great to be through the first half of the year. The S&P 500 just absolutely crushed it through the first half. Is that expected moving forward? We're going to talk about that. We're going to look at sector performance. Which sectors did the best? Which sectors did the worst? And look at a few stocks or sectors that I'm personally looking at for the rest of the year to close out 2023. So going back now up top here, let me go back to Jim's question, which he was talking about. We have these banks. He looked at some other videos, and there was a bank stress test. And what that is there's about 23 banks that went through the Federal Reserve's annual stress test. And what that is it puts in these different equations, like if we were to jump into a recession and unemployment was to increase up 10% or so, what happens to the banks? Can they maneuver their way out? Are they over leveraged in certain areas? If one of the areas was commercial properties, which is a realistic, those values come down, housing values come down, what would happen to the banks? Hypothetical type situations. All 23 banks passed that, which was great. And that was a very positive sign, not only for the economy, positive sign for the financial sector as well. Jim's question was focused around Bank of America. As you guys know, for those of you that are subscribed to my dividend newsletter, especially the premium subscribers that can see my dividend portfolio, know that I own Bank of America. I've been buying a little bit more and more of Bank of America, trading at around 8 times, extremely cheap for the second largest bank here in the U.S. So, definitely a bank to look at closer. After this dividend stress test, a lot of banks came out and announced new dividend hikes. You had J.P. Morgan announcing a 5% dividend hike, and Wells Fargo announced a 10% dividend hike. So expect some of those moving forward here. So, but let me know, where are you guys all viewing from? I love the question, Jim. Sorry, I don't know what's going on with the new sound here. We had it up and running a second ago, but let me know where you guys. I'm just scrolling through the comments here. I see a lot of people telling me there was no sound there, but we are good to go. Southern California for Kath. Kath, thanks for viewing in. Jim is from Nebraska. Awesome. Thanks for tuning in, Jim. Barcelona, Spain. Lisbon there. There's Barcelona. Awesome, guys and gals. We got Georgia, Columbus. Awesome. Great to have all of you. We have East Lansing there with Kevin. Kevin, I think you've been on one before, or it may have been someone else, but my brother lived in East Lansing for a number of years and enjoyed his time there. He actually moved back to Southern California. His wife's family was out in the Michigan area, so that's why they moved there. He got a job and now is back here in Southern California. We got some folks from Jim C is from Oregon, formerly Riverside, California. Went to school out there at Cal Baptist University. So awesome. Trey is SoCal, and Kevin is a returning viewer. So awesome. So if this is your first time coming to the Dividend Power Hour, we just like to talk economy. We like to talk stocks, dividend stocks, growth stocks, even any type of stock, any questions that you have. That's the idea of this Dividend Power Hour, is just to be able to interact with you guys. I do my 2 videos each and every week, primarily focused around REITs, dividend stocks, ETFs, and everything of that nature. But it doesn't allow me the opportunity to interact one-on-one live. So that's exactly why we do the Dividend Power Hour. I set up a slew of slides just to go through certain economic updates. But as you have questions, just spit them out, and I try to get to as many questions as I can during our time together. So with that being said, let me load up the slides here, and we will start going through it. So again, this is the Dividend Power Hour, and it is July 1st, and we are halfway through the year already. It's crazy to believe it. You know, summer's almost halfway over. It feels like my kids just got out of school. Some kids actually did just get out of school. Mine got off. They've been off now for a full month. But the first half, the S&P 500 just crushed it. They were up 16%, but the index was up 16% year to date. But the NASDAQ was the true outperformer of the first half, up a staggering 32%. And in the quarter, Q2, it was up 13%. So it just continued climbing higher. It's been a record-breaking first half. And it kind of makes you wonder, is there anything that's going to slow this market down right now? And that's where we kind of go into valuations. So, once we get through Q2, we're going to start seeing some new EPS estimates. So for the time being, we're going to stick with our 220, which has kind of been the consensus for the market. That has as of the Friday close, yesterday's close, the S&P 500 now still trades at 20.2 times, which is a very inflated multiple. We talk about it each and every week. Prior week was 20.1, so very similar. But as we know, the average is usually around 16 times. So very, it's one-sided. We're going to look at it here in a second. But in terms of employment or unemployment, jobless claims actually dropped 26,000 last week in the weekly jobless claim. That was the biggest drop we've seen in 20 months. So since going all the way back to October of 2021, we're sitting at 239,000 compared to what was estimated to be 265,000. So that was a surprise during the month there. One thing where investors are starting to get a little bit more pessimistic is looking at this betting short here. And if you're familiar with it, when you're investing in stocks, you can invest for the long term. But there's another way to do it, is you can short stocks. It's essentially where you're going to borrow stocks from, I use Fidelity, I use Vanguard. You're going to borrow stocks from the brokerages. You think about it like that, and then you're going to sell it immediately. So you'll be able to collect your money, but you're betting that the stock is going to go down, because what you do is you now owe Fidelity, let's say 100 shares of Apple. If the stock goes down from 189, which is where you borrowed it and sold it, and it goes down to say 160, well, you're going to buy 100 shares of 160, and you have your income or your profit is going to be the difference between 190 and 160. So $30 per share, you're going to buy it at the lower price, and then you're going to give it back to Fidelity. So that's how these short sellers are really starting to look at a lot of these technology companies. Actually, that's the main sector. It's a huge outperformance, which we're going to look at. The likes of NVIDIA up 180%, something like that. Meta Platforms up over 150%. All of these big tech companies have really carried the torch for the S&P 500. So investors have really turned short and against the stock market moving into the second half. And when you look at it, short interest has reached $1 trillion, which is actually the highest level since 2008. And we all know what happened after 2008. So it's always something interesting to watch, especially when you're looking at economic news. Now looking at the jobs report. So we just looked at unemployment. And now coming up in next week, so it's a short week next week. The markets are open only about a half day on Monday. We have the 4th of July holiday on Tuesday, and then you have a regular market moving forward there. So it's a little bit of a short week. But and usually there's not a lot of trading volume during these holiday weeks, but there is a big economic report coming out, and that economic report is the June jobs report. So that's really, how is the Federal Reserve? They're trying to maneuver into this soft landing. And what that means is they're trying to impact inflation, bring inflation down, because as we know, everything is expensive now, from gas and food and anything, anywhere you go, it's high prices still, as inflation's sitting around 4%. But as they increase interest rates, it's going to put more pressure on the economy and spending, but they're trying to do it in a way to where they don't see unemployment move up all that much. They understand that unemployment is going to move up. And the more people I talk to, the more people I interact with, I'm hearing more and more folks that are losing their jobs. It's an unfortunate situation, but this is what the Federal Reserve is trying to maneuver. So the June jobs report is going to tell us a little bit more this next week on how many jobs were added, hopefully, during the month. So the investors will definitely be looking at that. In more recent news, student loan, there was the Supreme Court rejected the administration's plan for student loan forgiveness. This came out yesterday. The administration also had announced a new path to try and get relief there. So this has been something that we've talked about both in our newsletter that we do on a weekly basis, as well as here on the Dividend Power Hour, and how the consumer discretionary spending would definitely come down, because now we're going to have to worry about a $400 per month student loan debt. So how this kind of plays a role right now, they're supposed to start back up in October, but we'll see where that goes moving forward. So now turning our attention back to the first half, this is the sector performance. So we know the S&P 500 climbed about 15% or 16%, sorry, during the first half, which, in a given year, 16% is a solid performance. Like if you got 16% for an entire year, you're like, man, that's double what the average is per se, on average for the S&P 500. But 16% in a year, that would be awesome. We just did 16% in 6 months. So where is that going to go? That's going to be our question here coming forward. Where do you think the economy is going to go here in the next half two? But first, let's look at the first half performance. So as you can see and probably guess, information technology was our leader during Q1 and Q2, up 42% year to date. Communication services, which is going to be your meta platforms, that was up 35%. Consumer discretionary was up 32%. Industrials up 9%, materials 7%, and real estate. There's a lot of pressure has been on real estate of late with higher interest rates. You see, a lot of REITs are down. They eked out a 2% gain through the first half. So still they're hanging in there. Consumer staples were flat. And then the other 4 remaining sectors were actually down on the year. And we know financials had their mini financial crisis that they went through. They were down 1.5%. Healthcare was down 2%. And then utilities and energy, bringing up the rear, were both down 7%. And that's kind of a flipped script there for energy, which was the leader in 2022. And information technology was under a lot of pressure. They've kind of traded places here in 2023. So if you guys have any questions, make sure you guys put those in the comment section. I will get to those as quickly as possible as I see them. I'm seeing some other folks here. Justin Thurman also went to CBU. Awesome. Happy Valley. Awesome. Another Lancer in the house there. Punisher is from St. Louis County. I'm just catching up on a bunch here that I may have missed. So Jim C's got a question. Let's take a look here. Beginning to sell some long-term covered calls out June 20 to June 24 on some of my dividend stocks near 52-week highs and on the overvalued side. Thoughts? Jim, I think that's a great way, especially if you have a lot of shares. It's a great way to lock in some of those gains and get premium. If you put those out, to June 24, I don't usually do them that far out. For me, it's usually about a 4-week thing, and I collect it on a regular basis. So I don't usually do the annual covered calls, just because this excuse me, this market has been resilient, and it continues to plow higher. So that's a little bit far out for me, but I like the strategy right now in the near term of selling covered calls. What else we got here, guys? Hi from Pittsburgh, Murat. Great to have you. PG, J&J, and Apple are my top stocks for PC. Awesome. Those are some good ones there. It's pretty well diversified. Consumer, Johnson & Johnson with healthcare, and Apple is just, I don't know how Apple keeps going higher. And they're now at a $3 trillion market cap closing this week. So that is crazy to me. Awesome. We'll keep the questions coming. We got Salute from Zug, Switzerland. Awesome. Guy is in the house from Switzerland. All right, let's keep crushing to our first question here. First question of the day. Will the S&P 500, so we closed at 4450. Do you believe the S&P 500 will close above 4450 or below 4450 by the end of the year? Let me know in the comments section. I will give you guys a second to answer that. In the meantime, at the bottom of this, as we continue to go throughout the slides, you'll see my weekly newsletter, the Dividend Investors Edge. You can go to thedividendinvestorsedge.com. You could sign up. We have a free version which goes out each and every week. It kind of gives you an update on the economy. Some of the stuff that we cover here on the Dividend Power Hour, And then you can also become, it gives you the opportunity to become a premium subscriber as well, which you get multiple stock deep dives that I go through. So just yesterday, we released our second deep dive of the month, which was Apple. And prior to that, the other one for this month was Visa. So we go through the stock, do company overview, and we look at a bunch of different valuation, how the stock's been growing in revenues, how the stock's been growing its free cash flow, looking at how debt and EBITDA, debt to EBITDA metrics, and a whole slew of different things that are within that about 10-page write-up for, to help you make more well-informed decisions. We're also updating our valuation dashboard, which will be out. We just did a major update to that, so I didn't want to put that out too early. But that'll be coming out for premium subscribers there as well. And then you also get access to my dividend portfolio, has all of my positions. And every month I do a write-up to kind of give you an update of what happened during the month. What did I buy? Did I sell anything? What was the dividend income? What's my projected dividend income? As well as all the different positions that I own, which is up about, I think last I checked was close to 35 different positions in that portfolio. So let me know in the comments, do you guys believe the S&P 500 will close above or below its June 30th, so which was 4450, by the end of the year? Let's see what we're saying here. John thinks above. Jim also thinks above. John C is saying below. Awesome. Keep those coming. So let's keep rolling here and looking at student debt. So we mentioned that the student debt forgiveness stuff with the administration was struck down by the Supreme Court. And we've talked about it on prior Dividend Power Hours, how this could have a true impact on the economy, because we've had a lot of these folks that have all this money and they have extra money. Hey, I don't have to pay my student debts right now. I can go buy a new iPhone, a new MacBook, a new VR headset, or whatever it is. But now you have all of a sudden, for the last 3 years, haven't had to pay those bills. Now those are coming to fruition starting in October. So the administration was trying to get a lot of that relieved. I think it was up to around $10,000. And the Supreme Court essentially said that is unconstitutional. We're not going to do that. Yesterday, the administration came out and said that, no, we're still going to try and make do on the promise that we had and find a different way where you get 12 months where you don't have to pay it. If you can pay it, it won't hurt your credit. And it's just a wishy-washy how it is right now with the new rules, but they're trying to find a different path to do that. But in the meantime, we have to go with what we have. And what that is a student debt that is approaching $2 trillion, which is just insane to me to think about. We're sitting at $1.8 trillion in student debt. So this is a huge thing that can definitely impact the economy moving forward, especially those in the consumer discretionary sector. So in terms of dividend increases, we talked about this earlier with the, there's a lot of ETFs that came out and did increases, but what I just show you here is some notable single dividend stocks. So General Mills came out with a 9.3% dividend increase in the recent week. JP Morgan and Wells Fargo were the other two coming out of the stress test. JP Morgan was going to bump their dividend 5%, followed by Wells Fargo was bumping theirs 17%, which that one's, a 17% increase is quite solid for me there. So let's take a look here at some, let me share my screen for you guys. And let's look at where some of these dividend increases are. So JP Morgan increased it 5%. So if we look at JP Morgan, we go over, and what I'm using here is Seeking Alpha. You can see they have a 5-year dividend growth rate of about 13%. So the 5% dividend hike that they just did wasn't all that exciting to me. They've increased their dividend now for 9 years. This will update in a second. They have close to a 3% dividend yield. So they kind of underperformed there. But in terms of Wells Fargo, let's take a look at them now. Wells Fargo had to do their dividend cut. So that's the reason you're going to see this 5-year dividend growth rate being negative. So they're now increasing it back. And if you look at the dividend history here, you could see the cut happened during the pandemic there. So we went from 51 cents on a quarterly basis down to 10 cents. So they're working their way back up now. And that's hence why we get a 17% dividend hike coming here for investors. So that was, well deserved for investors that have stuck with Wells Fargo. I don't own Wells Fargo. But if you do own any banks in the banking sector, let me know. I own Bank of America. That's the only banking stock that I own in terms of financials. If we go into more of the financial sector, I also own Visa, which is a stock that's actually been doing quite well. And as I mentioned, that was our latest, one of our latest deep dives that we did for premium subscribers to the Dividend Investors Edge. So let me jump back here to questions and going through those. Get myself back on the screen here. So what do you guys have for questions here? So Kevin thinks we're going to be slightly above where we're going to end the year. Jim C's got a question here regarding S&P 500. Fast graphs seem to indicate that SPY is trading near historical valuations for the past 11 years, and that's not something that's hard to believe. I can't. I don't have fast graphs pulled up here right now, but that's definitely something that kind of makes sense with how hard and how fast we've moved. 16% just in 6 months is quite the move. But as we're going to see here in a second, it is one-sided. The way I like to look at it is, and let's just pull up those. I think that might be the next slide here. Yep, there we go. Perfect timing. So when we're looking at here, and the way I look at it when things look one-sided is I like to compare the equal weighted S&P 500, similar slide that we had last week, just updated. But I like to compare the equal weighted S&P 500 to the regular S&P 500. So the regular S&P 500 is market weighted. So you'll see the top 10 holdings over on the right side. Apple has a 7% weighting. Microsoft has near 7%, Amazon 3%, so on and so forth. So anytime those top 10 holdings move, it pulls the whole S&P 500 with it, especially those top two or top five or so, because Alphabet's on there twice. So you need to combine them to see their weighting. They're actually the third largest weighting in the S&P 500. And when you have Nvidia that's shot up the boards there, you have Apple that's outperforming Microsoft. You could see how this S&P 500 is moving, but it doesn't tell you the whole picture. So when you look at the equal weighted S&P 500, you'll see that is actually only up 6% on the year. So you have the S&P 500 at 16%, and then you have the equal weighted only at 6%. Now, they're not always going to be the same, obviously, because these larger ones, tend to have a little bit more growth in them, but that's kind of a wide gap. And that tells me that there's a lot of stocks that are actually underperforming. And you see there at the bottom, nearly 350 stocks are actually underperforming the index. So they don't even have returns of 16%. And the top 10 has accounted for nearly 90% of the index's total return through the first half of 2023. So it's really something to watch closely. And if you want to follow the equal weighted S&P 500, you can look at, I'll pull it up here, go back to there we go. And if we look at RSP is what you want, the Invesco S&P 500 equal weight ETF is a way that you can look and see how things are doing here. So that's how you go to year to date. You can see the 6% return for RSP so far this month. So you go over to holdings, you can see everything is relatively the same across the board. So RSP, if you want to follow it, is the Invesco. I don't invest in it, but that's one way to kind of track where things are. What questions do you guys have, if any? Lex, good to see you from Louisiana. Thank you for that love. I love putting the videos out and just talking stocks. It's one reason I started the Dividend Power Hour, is just to interact with you guys and just take a break from just talking directly to the camera, even though I'm still talking directly to the camera. But at least I feel like there's folks out there that are interacting, and that kind of makes it fun for me and to kind of get your guys' questions and hear what your guys' take is on the stock market too, because it's always good to get different perspectives there. So let me catch up on some of these questions here to see what we have out in the crowd. All right, Benny's got a quote. I really like Lowe's stock, LOW. They have a lot of debt. How serious is negative debt equity ratio, especially in their case? For Lowe's, I like to look at the free cash flow and look at the free cash flow yield, which is pretty good for a company like that. So when they're generating, and the reason I like to do it for dividend purposes, and I like to do it for debt purposes. A lot of folks get stuck on payout ratios, EPS payout ratios, which is looking at net income, looking at your EPS compared to your dividend per share, and see what that percentage is. If it's below 50%, it's usually pretty solid. You can continue growing at a strong clip if you're a dividend growth stock. But free cash flow is the true thing that you want to look at. And the reason being is you take your cash flow from operations, you subtract out your CapEx, that really gives you your general free cash flow. And from there, that's where dividends are paid from. That's where debt is paid from. So if you have strong free cash flow, that is telling me that I can still pay my debt. I pay extra debt if I need to, and I can still pay my dividend. The EPS, the regular EPS payout ratio, the dividend and debt has already been paid. So I'm not really comparing apples to apples. I want to look at prior to getting paid. How much room do I have to pay the dividend, pay debt, and also reinvest into the company? I know a lot of people out there say, hey, dividend stocks, I would rather that money be reinvested to the company. Well, they are, buddy, they do reinvest into the company. They don't pay out everything to us, or else that would be a 100% payout ratio, not something that us dividend investors want to see. We want to see the company continue to reinvest into the business to generate more growth moving forward. But any situation out there, when you invest in a business, don't think about stocks. Say you went into 4 ways with your buddy, bought a business. After 5 years, would you want some sort of return on that business? Like, hey, can we get some profits back? The company's turning a profit. I don't think many people out there would go, hey, it's been 2 decades now. Make sure you just keep reinvesting. I don't want any return back. No, everyone wants some return back. You want to get back what you put in, essentially, and that's how dividends work, and a lot of misconceptions that are out there. So in terms of lows, I think they're under CEO Marvin Ellison. I think they're really closing the gap with Home Depot. As you've seen a lot of my other videos, Marvin Ellison is a former Home Depot senior executive there. He wasn't at the executive branch, but he was in the senior leadership role, I should say. So he kind of knows what the ins and outs of Home Depot were, at least back in those days. They were a very efficient company. That's one of the trademarks of Home Depot, a very strong balance sheet, very efficient in everything they do in terms of all the metrics. And you're starting to see that play out here with Lowe's. So that's a company that I like a lot. So great question there. JP Morgan there. Not sure what the name is there, but Wayne is GM, just finished watching a couple of your videos. Awesome. Thank you, Wayne. Jim with a question here. What are your thoughts on dividend harvesting? I had some money on the sideline and dumped 11,000 into RITM, caught the dividend, and it looks like I'll make 5 cents per share in price appreciation. So let me pull up, I'm still on the screen here, and show you guys what Jim is talking about here. So that didn't work quite well there. There we go. So in terms of dividend harvesting, for me, Jim, it's really focused on long-term investing, and not trying to. There are some folks that like to say, hey, the X dividends tomorrow, let me jump into stock now and grab that dividend income and then I'll sell it. I'm not someone that focuses on that as much. I'm more the long-term investor, trying to get in at reasonable valuations. For me, I don't get into a lot of this high yield stuff. I don't own JEPI, I don't own JEPQ. That's kind of turning away from the question a little bit. But there's people that want to jump into just get higher yields. So not something that I'm all that focused on, to answer your question, and not really yield chasing as well. For me, for some of the cash that I have high yield savings accounts. That's going to be my, I think it's around 5.25 right now is the high yield I'm getting. I use Marcus by Goldman. So yeah, I've sent out the link to that for folks before. So definitely a solid one to check out there as well. Kath has a question in terms of two of my favorite dividend ETFs. We don't have SCHD on there, but DGRO versus DGRW. Let me show you guys what we're talking about here. So DGRO, that both of these are focused on dividend growth. DGRO is the iShares Core Dividend Growth ETF. And when you look at holdings here, you're going to see a lot of healthcare, financials, technology. Top holdings include Microsoft, Apple, Johnson & Johnson, JP Morgan, ExxonMobil, Chevron. So a lot of the top S&P 500, solid companies right there, companies that continue to grow their dividend. If we cruise over here, we can see the dividends around 2.4% right now. And we see that it's been growing at around a 10% clip, and it's been doing that for 8 years. Now, if we turn over to DGRW, the other thing I want to look at real quick for DGROs, you always want to look at expense ratios. We talk about in our videos. This one sits at 0.8%, pretty low there, which is a good thing. You don't want high expense ratios because that will eat into your total return. So DGRW is more of an actively traded in a way, higher expense ratio, still not terrible. 0.28 on the higher end for me. I try and stay, below that 0.4, call it. Anything above that's pretty high for me. But DGRW, a very solid one that I've been taking more interest in. And when we look at the top holdings here, you see, a lot of the same names, especially the top three: Microsoft, Apple, Johnson & Johnson, Broadcom, which has just been crushing it, Procter & Gamble, Merck, Home Depot, Coca-Cola, Philip Morris, and Cisco Systems. So you can see a lot more technology based, whereas when we compare it to DGRO, technology wasn't up there, healthcare was. So if I were to look, I would expect that DGRW is outperforming the likes of DGRO. And I already know it's outperforming the likes of SCHD because SCHD doesn't have as much technology exposure. So one reason I like DGRO, though, is because of that technology. I'm still getting the growth, but it's also well diversified. You see Johnson & Johnson on there, one of my top holdings, a favorite company of mine. Broadcom is one of my holdings. And then, companies that I may not own, like Procter & Gamble, Merck, too. I would like to own eventually, don't own right now. Home Depot, fast growing dividend. Coca-Cola's, been underperforming, but a solid company nonetheless. If we look over at the dividends, you can see that this one's been growing around 10% clip. Haven't been growing as much, but it's a less of a yield right now. So 1.88, but again, that's looking at trailing 12 months. So TTM is trailing 12 months. Here's the latest dividend announcement, was 12 cents, but they pay on a monthly basis. So something to consider there. So in terms of which one, I'm looking very closely at DGRO, DGRW, but I already own DGRO and SCHD. So I don't know if I want too much of the overlap there, but you can never have enough dividend growth. So really, to answer your question, Kath, they're two very similar. It's really, what is your portfolio overexposed to right now? If you already have a ton of technology, maybe DGRO isn't that answer for you. Maybe it's DGRW, because remember, they have the large technology holdings. Look here, holdings, 30% technology. So if you already have overweight exposure to technology, maybe this one doesn't fit the bill. But if you don't, then this one could be a perfect addition to your portfolio. Where do you get those charts? I'm assuming what the charts you are referring to here, what I'm using is Seeking Alpha. So this is I use Seeking Alpha a lot. I also use Fast Graphs are the charts I use in a lot of the videos. So if that's what you're looking at, but let me know which charts you are referring to. All right, what other questions do we have here, guys? And then we'll keep rolling. Oh, I got a lot to catch up on here. Wayne, I'm still 50% cash. I have a couple of BTCs. Have not seen you address those. Number one holding is ARCC. I've had a lot of questions on those BDCs and stuff like that. So I'll try and get a video out soon. Not sure how well it would perform, but it's worth giving it a try. Not going to access the charts. BDCs, I got you there, Wayne. And by the way, I'm 67 and retired. Congrats on retirement there. All right, let's keep rolling here with the slides. So that was our one-sided rally. Looking at our second question now, which sector do you think will outperform in the second half? Remember, we looked back a few slides. We had technology. Let's look back at that slide deck there. We had information technology was up 42%. Communication services, was up 35%, and consumer discretionary 32%. So those were the three leaders of the S&P 500 in the market through the first half. And the laggards, let's just look at the four that were actually down on through the first half. Financials down 1.5%, healthcare down 2%, utilities and energy bringing up the rear down 7%. So looking at these sectors here, to answer question number 2, which sector do you believe will outperform in the second half? Do you think information technology is just going to continue to storm higher? Or do you think some of these laggards are going to turn? Do you think maybe the winds might change a little bit and the economy might start facing some headwinds to where information technology may start to look overvalued and may start we're seeing higher interest rates continue to weigh on those. So let's see some of those answers there. Which sector do you think will outperform in the second half? Let's see the answers in the comment section. So we got a vote for healthcare will catch up. I tend to agree there. I'm hopeful that will be the case, considering that I'm overexposed to healthcare. This is one of the best videos you have out there. I'm glad you guys are finding value. Again, it's always great to interact and get other perspectives and just be able to do it live and just talk live. I have fun doing it. Jim is going to go with real estate. So REITs, there's a lot of value out there with the REIT sector. You have the likes of American Tower, and I'll be doing a video soon here on REITs. I know, that usually performs quite well. People like to get the take on the different REITs that I'm looking at. But you have, American Tower, you have CCI, two cell tower REITs that are just trading, dirt cheap right now. You have Realty Income trading at over a 5% dividend yield right now, which I've mentioned on this video. Or on this live stream, a number of different times. It's always a great entry point for me is the 5% dividend yield. And I recently added to my position in Realty Income, just slowly nibbling. Anytime it's at that 5% yield, it's proven to be, a great time looking back, historically. So a lot of great REITs out there, and couldn't agree more, Jim. So Lex is looking at financials, especially large banks. Definitely agree there. As I mentioned earlier, Bank of America is one holding that I own. And then, outside of banks and still in the financial sector is Visa. And if you saw, I know Lex, you're a premium subscriber. You saw the Visa write up, hopefully. And that's a stock that I tend to like a lot and think, it's a higher multiple stock, but it's also giving you a lot of growth. So it kind of fits that mold for higher multiple. Now, when you compare that, and it's not apples to apples, no pun intended, we're going to talk about Apple now, but Apple's not growing at that fast. So when you have higher multiples, you expect a lot more growth. Apple analysts are expecting, that high single digit EPS growth for the next few years. That's not something that I'm looking to pay 30 times, a 30-time multiple for. Now, Visa, they're going to be trading at 15, 20% plus EPS growth over the next few years. That's a company that's growing fast, growing their net income, growing their free cash flow at a strong pace. That's a company that I'm willing to pay a much higher multiple for. So that's where you want to look at, a lot of those multiples there. And one reason that I like Visa at these levels right here. Michael's got a question here. What do you recommend for a taxable account? Market index or realty income? So for taxable accounts, so to step back, I have a Roth IRA. I try and put as many dividend stocks as I can in my Roth IRA and take advantage of, you're getting paid a monthly, quarterly dividend in order to not get taxed on those. So I try and cram as many dividend stocks, and I have, the majority of my dividend stocks in my Roth IRA. So in terms of priority for me, when it comes to investing, I have my Roth IRA is going to be my top priority. For after that, we'll have HSA, we'll have 401k up to the match. And I've talked about this a lot with a lot of folks that do the 6-week investing accelerator course with me on a couple of reasons on why I don't like the 401k. I'm not a big proponent of it. I'm just going to go to the match, and that's it for me. I like to be more involved with the exact stocks that I'm investing in. Plus, a lot of those mutual funds have high expense ratios. So you see, when we were looking at DGRW, that was 0.28. That would be extremely low compared to a lot of those options that 401ks have to invest in. You're thinking about things that are over 1%, 1.5%, and those really eat. They sound like small percentages, but those really eat into total returns over the lifetime. So definitely something to think about, and that's kind of my priority that I look at. So Benny, I think and hope REITs go up in the second half. Benny, right there with you. As from watching other videos, I invest roughly 20% of my portfolio into the REIT sector. So I have a lot of love for REITs. I don't invest in REIT ETFs. I kind of build my own mini ETF with some of the high quality ones there. Oxy, do you think that will recover? Let's take a look. Haven't looked at it, don't own it, but I know Mr. Buffett does. So he tends to like it. So let's take a look at where Occidental is. So Occidental right now is down on the year. They're pretty much flat year to date, though. They're down 3. So it's not terrible right here. You could see that back a couple days ago, Berkshire boosted its Occidental stake to 20. He just keeps buying. It's incredible. And he probably timed it quite well because they probably bought it around these lows of 55, 56 right there. So energy's been a tough space. With the demand, they were hoping for a lot more out of China with the reopening there, but that just continues to be slow. If the economy continues to slow and we do see unemployment kind of tick higher here in the U.S., that'll lower demand as well for these oil, for the energy sector as a whole. So it's not a sector that I'm putting a lot of dollars to right now and have a lot of focus on. So that's more of a, I don't look at Oxy all that closely. So, but that's more my take on the sector as a whole. What other questions do we have here? Nacho says real estate WPC at its 52-week. Yep, definitely. That is a great one right there. And what the thing is, and I've mentioned it in prior videos, is with WP Carey, this is a company that's really transformed over the years. They had a lot of office space. If you go back, 5-10 years, you'll see the office exposure is quite large for a company like WP Carey. They have transitioned. The timing actually started before the pandemic, but they have transitioned away from that and more into industrial and warehouse, which is a great space to be in. Office is really struggling. Unless you have Class A office, prime location office, you're going to struggle. A lot of these Class C office buildings are, have 50% occupancy rates. So default rates are going up. A lot of these buildings, though, for commercial real estate are going to have to be refinanced. Values are coming down. So office is a tough space right now. With exception being something like Alexandria Real Estate. That's a company that, I continue to like, even though it's been under pressure. I think there's a lot of misconceptions out there around Alexandria Real Estate, but WP Carey is another one that fits the bill. And if I'm not mistaken, I believe I actually bought this last week. So that was one question we haven't done. We usually do at the top of the Dividend Power Hour, but we had our sound issues. Let me know, which stocks did you buy this week? I'd be curious to hear. I know I nibbled in Realty Income, and I'm pretty sure I bought some WP Carey as well. So in the comment section, let me know which stocks did you buy this past week, so I know what other folks are buying out there. But again, going back to Nacho's question, WP Carey trading at 52-week lows, have a high exposure to around 50% of their annual base rent. I think it's above that, is exposed to industrial and warehouse. And as e-commerce continues to climb, may have some headwinds here if we do fall into a recession, but that's a great spot to be in. It's a big sector that I like. That's the reason I like Prologis, which has been doing pretty well here of late. So PLD is another industrial type warehouse REIT. Their largest tenant is Amazon, which is pretty solid. They're up 4% over the past 12 months after having a rough little run there, but up almost 10% year to date. So that's a solid REIT there, and one that has kind of pulled the REIT sector forward. So let's see, what did you guys buy this week, and what other questions do we have? Jim's going back here. The 401k is great, especially if your employer matched. Exactly. So for me, when I was in private, I would go up to the employer match and just do that. HSA was, that is also something that a lot of people don't, you can invest. You're pretty much paying your healthcare bills at say a 20% discount. When you put pre-tax money into an HSA, you're allowed to, again, it's an employer based here, but you're allowed to invest the money that's just sitting there and waiting to be used on healthcare needs and costs down the road. You can invest that money. So that's definitely a key. So you're putting in pre-tax money and you can invest it. Pretty solid there, especially over the long term as a retirement way. Benny's got a question on Vici, one of our favorite REITs that we talk about on this channel. Do you think Vici is going to buy Blackstone's stake in Bellagio? I did see that. Someone put out, I think it was on Twitter, someone had put out a poll asking who do you think is going to buy it, and I voted for Vici. I would love to see Vici. They're already the largest landlord on the Las Vegas Strip. Why not add the Bellagio to it? So I don't know what the figures are in terms of the Bellagio, if it makes sense for them, but that would be a great addition to the Vici portfolio. EQIX, one of the largest REITs out there, data center REITs. I'm pretty sure that let's compare. They've been under a ton of pressure the past few years, but now they're kind of pulling out of it. Them and DLR year to date up 18%. And if we look over here at Digital Realty, there's that late boom that you could see from $86 towards the end of May, all the way up to $113 now. So they've had a huge run just in the past month alone, up 12%. So those are the two largest data center REITs. The one I like that I own that has exposure to data centers is Iron Mountain. So Iron Mountain's been a solid company for me that I've had for a number of years. One of the stocks that I'm up, I have huge gains in over the past 5 years or so. But 62% over the past 5 years, but I was in here in the low to mid 20s. So sitting at a great cost basis, stock has continued to plow higher. You're getting a great dividend yield. A lot of folks haven't liked it over the years, but they have kicked them back in the teeth and just continued to climb higher. They do have exposure to data center REITs as well. So another area to look. Those three that we just mentioned are great for those looking for data center exposure. So what did you guys buy this week? John bought some Realty Income and DEA. Awesome. Benny this week added AbbVie, T. Rowe Price, Realty Income, Vici, and J&J. That right there is a solid portfolio right there. AbbVie's been under a ton of pressure dealing with their Humira cliff, their patent cliff. T. Rowe Price is a they have a fast-growing dividend stock, even though the latest raise hasn't been all that much, but that makes sense. We're facing a potential recession. A lot of companies are trying to preserve cash, but we look at their 5-year dividend growth rate, and this is coming down after a week recent hike, but still around 15%, but they've been doing it for 36 consecutive years. You're getting over a 4% dividend yield. That's a yield that was trading around 1 to 2% just 5 years ago. So cheap valuation, high dividend yield, strong dividend growth. Great job there with T. Rowe Price, one I own, although it's on the lower end of my my portfolio. Kevin bought some DFS as well as some BAC, Bank of America. Lex also bought UNH. I was right there with you, Lex. I think we spoke about that one. ADP planning to add to United Health and FTSE All World high dividend yield ETF there. So some good ones there. What else we got? Recently, EQT and GM. What Jim buy? Jim bought some Maine, some Stag. Oh, Jim likes the monthly dividends. I can see right there. RITM and PFE with Pfizer. Murat likes the Next Era Energy. That's a solid one there. And what else we got here? Recently bought Vici, PepsiCo, and SCHD. So solid buys there. And let's keep rolling with it. If you guys have questions, keep rolling those through and we will get to them as soon as we can. So the market goes in cycles, as many of you know. We've been in this bull market that we saw from through the pandemic. It was about a 10+ year bull market, but in the past, starting in 2022 is when things started to get a little dicey and we've seen the declines. But now it's like, where are we? Are we in this sector where we're in a late stage bear market? Or are we actually starting to turn into this accumulation phase to where we're starting this new bull market? In the last live, if you guys recall, we were technically, when you look at bull and bear markets, really you're 20% off your highs or 20% off your lows. That's one way you can determine, are we in a bull or bear market? So you look at your 52-week highs, the market had fallen more than 20% off of those. That's technically now a bear market. But since then, just last week when we had our Dividend Power Hour, we saw that we had jumped more than 20% off of our lows, which was technically an indicator that we were now in a new bull market. So now when you're looking at market cycles, investors are trying to are we really in a bull market? We have all of these headwinds. We have interest rates continuing to increase, at least 2 more rate hikes. We don't see rate cuts in the foreseeable future at all. So are we in the accumulation phase on the far left where we're starting into this new bull market, or are we still in the decline with this bear market? So it's really been a tough for bulls and bears, just kind of struggling back and forth to determine where are we. And I think that's where a lot of the confusion has been for investors. So getting to stocks for the second half. And when it comes to the second half, it's hard to invest in the leaders right now just because of the run that they've seen. I mean, we've seen unprecedented, unsustainable runs. Everything's been focused on AI. So, I like to look more at the underperforming sectors. What will work in a slowing economy, assuming we hit into a shallow recession, at least, which a lot of people believe. But the thing you want to be mindful of is that although we have a shallow recession, just remember that the stock market is usually 6 months ahead of the recession. So the stock market's going to start moving higher prior to when the economy hits its lows. So we'll already be moving higher. That's where a lot of the struggle is with investors right now. They're seeing the stock market up 16% right now, year to date. And the struggle is, okay, are we actually moving up and the worst is behind us now? And now the economy is going to catch up and hit that recession? Or is this just an AI craze that jumped up? So it's a difficult spot. for investors right now. But for me, I'm going to continue to look at healthcare. I'm going to continue to look at technology, but I'm going to look more in the value. I'm not looking at Apple right now. I own Apple. I own Microsoft. Too high multiples for me right now. Unsustainable, I believe. So I'm looking more at the value tech. So I recently did a video on 4 dividend stocks for AI. Cisco is one of those stocks that I'm taking a closer look at. I used to own it back in the days. Got a little frustrated with management, but it seems like they're turning things around and starting to take advantage of security and AI there. So, and financials, looking to continue to add to my Bank of America position, looking to add to my Visa position as well. So those are really the stocks that I'm looking for here in the second half. Would love to know what stocks you guys think or would like to buy here in the second half. I can't vouch for an Apple at 30 times growing at a single digit multiple. Microsoft is a little bit of a different story. They're trading at very similar market caps, although Apple just recently passed 3 trillion, but similar multiples. But Microsoft has so much. They have cloud. They also have AI. They have the Office. They have the annual reoccurring revenue. So they just have a lot more in the portfolio and not so dependent on iPhones, iPads, MacBooks, Apple Watches, $3,500 AR VR headsets coming in 2024. It's a lot more software based, and they're growing at a much faster clip, although cloud has been slowing lately. So, I could see maybe dabbling a little bit in Microsoft, but I already own, it's already close to a top 10 position for me. So I'm not running to invest in something like that. So let me know, what are you guys looking to add to in the coming months? And as you guys continue to put those, I want to give you an update. I think this is our last slide here, but for the Federal Reserve. So we've mentioned that the Federal Reserve continues to add interest rate hikes. So they're saying we got 2 more rate hikes. And when we looked at it last week for the July, this is going to be the last meeting for about a month and a half, but the end of July here, last week's consensus was we were going to hike 67% and 33% said we were going to pause. Now, when you look at it, this was pulled here this morning. It has moved, the consensus has moved all the way over. It says, we're for sure hiking. 87% of the participants said we are hiking, and only 13% said that we are not hiking. So it's pretty set in stone that we are likely to get yet another 25 basis rate hike from the Federal Reserve here in July. And then we might have one more after that in the fall. So at least 2 more rate hikes, according to Fed Chair Jerome Powell. So with that being said, that wraps up that portion. If you guys do have questions, make sure you put those in the comment section now as we're wrapping up. But if you are looking for more information, I do have my weekly newsletter, the Dividend Investor's Edge. There's a free version. It goes out, just high-level economic activity reports, just my write-up, so you can get your information and stay up with the stock market all in one spot rather than going to a bunch of different sites. I put the top 5 stories that I've seen. I also give you a recap of where the major indexes are. What are some analyst upgrades and downgrades for notable stocks that we're looking at? Any earnings information that'll be coming in the coming weeks, as well as economic data that'll be coming in the coming weeks as well, to be mindful of as an investor so you can make more informed decisions. But if you want to take it another step, another level, sign up for my premium subscription, about $1 a day, and you can get my dividend portfolio to keep up with that, all my write-ups on my buys and sells, as well as 2 stock deep dives per month, and then our brand new valuation dashboard, which will be coming out very soon for investors. It will show you kind of analyst price targets. It'll show you our kind of discounted cash flow for a few stocks, and we'll continue to add to that each and every month. So definitely take a look at that. You could try it for 1 month. You can get a discount if you want to try it for the full year. So you can go to thedividendinvestorsedge.com and sign up there. So either a free version or the premier version, the premium version, if you want to take things a step further. So let's see what questions you guys have now as we wrap up today's Dividend Power Hour on this Saturday. Jim, I love it. He's on cue there. Half the viewers have not hit the like button. Smash that like button. Love it. Lex is buying Staples. Love it. Not going to Staples, the store. He's buying consumer staples, folks. Info ranker, 2 possible rate hikes. I don't believe those are certainties. I think I agree there. The one that's always kind of what I was expecting moving forward. I was like, okay, we'll get one more rate hike. The two came as a shocker to me, but they've kind of stuck to their word this entire run. A lot of folks have looked and said, we don't believe the Fed, we go against them, but they've really stuck to their guns there. So I'm going to have to believe them there. Jim C bought SCHD, Bank of America, and Pfizer last week. In Europe, we will have stronger hikes. In the US, I personally expect not that many hikes at the moment. Hopefully just the one or two more there. Thank you. I rewatched the video later on. We're almost wrapping up here, folks. So any last questions, get those in. Benny, I'd love to add some McDonald's and KR, but they're too expensive right now. I did recently look at McDonald's, and McDonald's is a little pricey. Jim, I like the defense stocks, RTX, LMT, and GD for the second half. No matter what happens in Ukraine, the government, US, or otherwise will continue to come in. That's a great sector. You can either do it through a defense sector ETF, or you can go into these individual ones. I own Lockheed Martin is one of my top positions, as well as have some Raytheon as well. General Dynamics is solid. Northrop Grumman is great as well. And then L3 Harris is another one to potentially look at. So there's a lot of great defense contractors out there, but LMT is the one I'm in the most right now. James Hopkins, Legal and General, a UK stock. So thank you guys so much for joining me on this Saturday edition of the Dividend Power. If you liked Saturdays, let me know in the comment section. Otherwise, we're going to return to Thursdays at 7 p.m. each and every Thursday. We come on here and just talk stocks. We talk the economy, interact with you guys. It's always fun. I know we had some sound issues at the start, but thanks for sticking with me. I hope you guys have a great holiday weekend. A happy 4th of July to those of you celebrating here in the U.S. And with that being said, stay safe, and we'll see you next week. Take care.